Hello, friends. Today we're talking about Exxon Mobil, ticker symbol XOM. In the past year, Exxon Mobil has been going up and down, and it is close to their 52-week lows. And the question is it a good time to jump and buy Exxon Mobil? Just a free, a disclosure. I do own Exxon Mobil. Also, just because I own it, that doesn't mean that you should buy it. I will encourage you to do your own research. This is just for educational purposes. I'm just sharing my opinions on why I bought it, and that doesn't mean that you need to buy it or is a recommendation. I am just thinking aloud in YouTube, and I would love to hear your opinions on my thinking. If I'm missing something, if there's any information that you just want to share, that would be awesome. Continuing with the video, as you can see, they reported earnings on October 27, and most analysts are thinking that in the next 12 months, the ExxonMobil will go close to $130. That's a 23% up from today's price. They are a dividend payer. They paid $3.80. That's about a $3.62. And for those that don't know, ExxonMobil is a integrated oil company. What that means is that integrated means that they do the three different segments of the oil industry. So the oil industry is broken down into three main segments: the upstream, midstream, and downstream. Upstream is pretty much finding oil and extracting the oil or gas from the earth, whether it's overseas or whether it's inland. Then the midstream is the business of transporting that oil to the refineries, or sometimes whether it's by ship or by pipelines or trucking or storing it until it's ready to be refined. And then that downstream is actually the refineries and the gas stations. For every a barrel of oil, I don't know if you knew this, it's 42 gallons of oil, and it gets transformed to an average of about 20 gallons of gasoline, 11 of diesel, and the rest on different oil products. So, ExxonMobil is a company that does all of that. It has all those facilities. So they, like I mentioned, they reported earnings on October 27th. They missed, but they didn't miss by much. I think that part of the reason why the prices have been going down, it has to do more with the instability of the oil markets, with what has happened with Russia and the Middle East. Another thing that they mentioned on October 11th, just before their earnings, is that they are merging or buying Pioneer Natural Resources, which is another company. This company is an upstream company. So it means that it finds oil and gets oil out. And the reason why I sold Chevron and I bought ExxonMobil is because of these deals. After I was looking at both of the deals, and if you want more information about Chevron, just look at my other video. The Hess has most of their oil. They have some in Texas, but they have mostly in Guyana, or they have a big presence in Guyana. And my understanding is what they're paying in compared to their value, there's a big surplus that what they're paying for. ExxonMobil, what I like about this is that, as you can see here, they're going to be paying $59.5 billion, which is about the same amount that Chevron is paying for Hess. But if you look over here, the market cap value is 55. So really, they're not paying that much of a difference. I think it's like a 5%. Well, maybe less. don't quote me on that, but it's so they're paying about $253 per share on a $240 company per share, and they're going to be assuming about half. So that's 4 billions, 5 billions on debt, which which implies the enterprise. Yeah, which that is almost half of what Chevron is going to be assuming from Hess. So the other cool thing about it is that it doubles the company's Permian footprint. For those that don't know, the Permian is located in Texas and New Mexico, and this is one of the biggest oil places right now in the United States where we get a lot of our oil. So that is, and they are expecting to generate double-digit returns by recovering recovering more resources. So I think that this is going to be really good for ExxonMobil, and that's part of the reason why I have invested on that. That doesn't mean that you are supposed to do that too. Okay, this is just a recommendation. In the past year, you can see that ExxonMobil has lost about 7% compared with Chevron, 23%. Another reason why I exited that position. And a Pioneer is negative 2%. In the last 3 years, ExxonMobil is up 171 dollars. Chevron, I mean not dollars, percent. Chevron is up 63%, and Pioneer is 185%. And in the last 5 years, ExxonMobil is 32.5% up. ExxonMobil 19%, and Pioneer is up 74%. So as you can see, at least I was owning ExxonMobil and Chevron, and after doing a little more research, I just decided to put all my eggs on ExxonMobil, which doesn't mean that you are supposed to do that. Okay, let's go into looking at the financials. Revenue goes up and down because it goes depending upon the prices of oil and gas. So, but revenue stays a little consistent. Earnings, it has in the past 10 years, it has stayed above. It has not shown any negative earnings like Chevron, but except for 2020, everybody had that issue. And as you can see here, the 5-year profit margin is about 7%. Free cash flow, also, another thing that I like about them is that they stay generally positive. Only 2020 they went negative. In the past 2 years, 2021, 2022, because of the oil prices, they have been making quite amount of free cash flow. In the past 5 years, they have grown 20% CAGR. In the last 10 years, 14% CAGR. I will not rely on this happening over and over and over. But as you can see, they stay consistent between $3 and $4 of free cash flow. That's a 5.6% average in the past 5 years. Book value, just like Chevron, it just goes up and down. It stays a little consistent between 40 and 50, which I'm sure is going to go up whenever they acquire the new company. Return on equity, it's 11%, which is higher than the 10% that I look. And then return on invested capital is a little low, a little under 10, which is okay. A return on assets are at 6%, which is over 5%, what I normally look for. Sorry about that. And dividends. Dividends had been growing up really fast, and then as you can see from 2019 to to present, it has been kind of staying flat. So in the past 5 years, it's grown only like 2.4%. Debt, they got in a lot of debt, which it is a little bit concerning, but it's not that much whenever you look at the long-term debt compared with the average free cash flow in the last 5 years. They can pay it in a year and a half. But this is something that I will be keeping an eye on, because if we are going to add up another $5 billion in long-term debt, that will put them at about $14 billion in long-term debt. Shares, they do go up and down, but not as extreme as Chevron. As you can see, they try to continue to keep it close, and it has been kind of going down. But they're going to be issuing quite amount of shares. When I was reading the announcement, I think what is going to happen is Pioneer shareholders will receive 2.3 shares of Exxon Mobil, which means that they're going to be issuing all of those shares. So that's going to get added up to this chart. When it comes to the historical valuation, the historical multiple valuations, if we take a look at the average, we're looking at a $99 fair price, while a year to date, trailing 12 months is about $138, which is close to what the analysts are thinking, which makes sense because right now their oil are going to be it's really high, and in the next probably 2 years, with the issues in Russia and Ukraine, probably those things are going to continue to stay high, especially here in the United States. The government probably is not going to be giving too many permits to make more oil, and so that's going to keep the prices a little high. However, if you're looking at the average, I will probably be looking more of about an $80 entry point as a fair value, which makes sense to me. Payback time, if we were to receive this amount of free cash flow back in 15 years, that would be about $151 fair value. I wouldn't count on that. I would be more confident with the average of 611, which will be about a $97 fair value. Discounted earning valuation. This is something that I will not pay too much attention to, because even though it stays a little consistent, it does change a lot. So if I were to look at this, thinking that it's not going to grow, it's just going to stay the way it is, starting with a $5.29 per share, the fair value will be somewhere around $34 when it gets discounted. Owner's earnings. The average owner's earnings is about $122 for value, and the trailing 12 months is $185. When we put everything together and ignoring the earnings, just like I did with Chevron, because it just goes up and down, we're looking at a fair value of $147 in the high end, which I think is what is probably going to be in the next year or two. But if you're looking for a long-term investment, I will be looking more at the fair value of $107. So if you take a 20% margin of safety, that will be an entry point of 118 for the trailing 12 months or $86 if you're looking at the average. I tend to look at the kind of the middle of the two of 102. That would be a upside of 20%, which is kind of close to what they are predicting over here. Well, that's all the information that I have. If you like if you have any comments or suggestions, please don't forget to leave a comment. Please don't forget to like or dislike this video if you don't like it. If you subscribe, that will help me a lot. Remember that this is just this is not financial advice. This is just me sharing the reasons why I bought XOM. So have a nice one.